Hello everyone, welcome back to our channel, The Wealth Capital. This is our second video creation. We are very new to this content creation market and want to give a quick introduction to the team. There are a couple of us managing this channel and we are traders at one of the bulge bracket banks managing a substantial book for the firm. We each have over a decade of experience in the market and have successfully built a solid trading track record in our day job. We are also active investors in the markets on a personal basis, leveraging on our own expertise to make informed investment decisions to make money on our own. And just like you, we are very passionate about the markets and love discussing trade ideas across markets and asset classes. We are starting this channel to share information, discuss trade ideas, and make money together. We are very new to this and would really like to hear your feedback on what you would like us to cover. We aim to engage further with each of you and build a sharing community. Today, we are diving into the second largest economy of the world, China's economic performance for 2024. We will try our best to break down some financial jargons and explain things as simple as possible. So let us get started. Earlier on Friday, China just released its Q4 GDP figures, which showed a surprising Q4 GDP year-on-year growth of 5.4%. This obviously came much of a surprise as it was even higher than most of the forecasts, which expected to be around 5% or an even lower figure. This basically rounds up the full year 2024 growth at 5%, aligning with the government's target of around 5%, which many would have thought to be quite tough to achieve, given the structural headwinds such as US-China tensions, TikTok ban, weak domestic consumption within onshore. So what is really going on in China that is surprising all the bears in the market? Just slicing the figures, we think that the surprise is mainly driven by supply-side indicator, while domestic demand indicators still painted a gloomier picture. Let us take a look at the supply-side indicator on what is driving the growth. Firstly, industrial production expanding at a much faster rate than expected to 6.2% year-on-year, even higher than the 5.4% that was clocked in November 2024. And this can be largely explained by some front-loading from Chinese exporters in anticipation of potential tariffs. Second, manufacturing sector also saw a big jump to 7.4% of growth, as we see an acceleration in steel, computers, chips, industrial AI, and NEVs. For domestic demand, things continue to point to weakness. Demand-side indicators underperformed supply-side indicators by a wide margin. Retail sales grew about 3.7% year-on-year, likely benefiting from consumer trade-in programs that the government subsidized, with household appliance sales rising by 39% year-on-year. Auto sales, although almost flat on the growth, has stayed in positive territory. This is also a good indicator of slowing growth for those who own NEV stocks. Sales of key discretionary goods, such as cosmetics and jewelry, are still punching a negative figure. Sales of communication devices picked up visibly, rising 14%, but this was only after major online commercial platforms made more digital products eligible for government subsidies in 2024 December. Although 3.7% growth in retail sounds like an okay number, this is in fact a decrease from the average of 3.9% gain in October to November. We compared December print with an average gain in October-November in view of the distortions related to the longer version of the Singles' Day shopping festival, which lasted from 14 October to 11 November, 10 days earlier than previous years, which may have brought forward some consumption from November to October. So overall, domestic consumption is still very weak. Next, we look at FAI, which stands for Fixed Asset Investment. Why do people care about FAI? Because FAI are longer-term investment to the economy. Things such as infrastructures, machines, buildings are much longer term measurement of growth than domestic consumption such as retail sales, which can be just one-off expenditures. A higher FAI figure means the economy is doing well and it reflects a positive growth and outlook of the economy. So just imagine if you do not think the economy is doing well, you simply would not spend any money today for the future of the economy because that will likely generate a negative return. Now let's take a look at what makes up FAI. You see manufacturing, property, infrastructure, private investment in this table. FAI year to date returned a positive 3.2% growth in December. But amongst the contributors, the biggest drag, which is the one that is pulling up the top figure down, is property, which is returning a double-digit negative growth. So we know that China is undergoing a structural change in its property market. This was brought upon by a series of defaults of a lot of the property developers in the market in the last 4 years. Even big boys like Evergrande, Country Garden and now Vanke have been struggling in both financing and also weak housing demand locally. Although the Chinese government has tried to introduce many measures to stimulate demand in the market, for example reducing home purchase restrictions, this has yet to prove a sustainable rebound in the market. You will see in this chart that after a short-lived rebound in November, prices in 70 cities continue to be very negative. Property sales in Tier 1 cities moderated, while sales in lower tier cities, which take up more than 80% of national sales, continued to decline in December. As you can see from these two charts, they represent the average selling price ASP in both the primary and secondary markets. The blue line represents the number of cities with ASP increase and the red represents with ASP decrease. The chart on the left is for the primary market, basically like those that are newly built, for example like BTO in Singapore. And the chart on the right is for secondary market, like those you can buy from existing homeowners or something like a resale flat in Singapore. And what you can see is that the red line, which represents the ASP decrease, is still significantly outweighing those that saw an increase, even in the last quarter after the stimulus measures are made in the property market. And on a month-to-month basis, new home prices have been falling for 19 months and secondary home prices for 20 months. So overall, things remain very weak for the primary and secondary sales volume and prices. And the data surprise underscores GDP growth as the single important KPI for Chinese policymakers under the Real Growth Targeting Policy Framework. And thus, although it seems difficult to achieve this figure from the current figures, we see that the government is very much willing to keep the growth target at around 5% after achieving this in 2024. To achieve that, domestic policy could turn more expansionary to offset external and internal headwinds, which means to say, if the growth falls short of expectations, policymakers would likely step up their support in a reactive manner. Some of these tools, such as more special government bond issuance, will help. More monetary easing through liquidity injections, such as the 50 basis point of the required reserve ratio cuts, and interest rate cuts of 30 basis points to come through this year. And even reducing the uncertainty of Trump tariff by slightly improving the narrative of US-China relationship could help. And with Mr. Trump inauguration, which happened earlier this Monday, market will focus on initial trade policy announcement and China's reaction in foreign exchange, which has caused some mixed views on whether an upcoming tariffs to be a trigger for People's Bank of China to further allow the renminbi depreciation versus a strong signal to stabilize its currency. That is all for today. This is our second content creation. We had over 22 viewers for our first post and would like to give a shout out to all of them for their support. We are very thankful and please continue to like, share and subscribe our channels and this will keep us going. We want to bring to you analysis on what's hot in the market, so please feel free to comment and give us idea on what you would like us to deep dive into. Thank you for watching, and we will see you in our next video.